Hello guys and welcome again to my channel. So today we're going to make the Copilot become our quiz master. Okay, so I already started a while ago and I have made a, what do we call this, a command so that uh, the Copilot will become the quiz master, and it is to give me one by one questions related to, what do you call this, let me type in, paste as plain text. So that is my command. Help me train in working capital management topics and financial statement analysis by being a quiz master. So give me multiple choice questions related to the topics and give me those questions one by one, and then let me answer first before going to the next question. So make it theories, short problems, and long problems. Find existing questions in the internet and don't make your own, please, for reliability. Let's add something. Make it challenging. Okay? So now the Copilot will become the quiz master, and it will give questions not made by it. It's from the internet, so it's from reliable authors. Okay, so let's start again. So I'm on question 4. Let's start again. Which of the following is the primary objective of working capital management? Of course, it's not maximizing long-term profits. It's minimizing short-term liquidity. It's not actually. It's ensuring operational efficiency. No. um I don't know about this. It's not maximizing long-term profit, so you have to eliminate that. Minimizing short-term liquidity. I don't think that you have to minimize short-term liquidity. But maybe ensuring operational efficiency and reducing fixed asset turnover. So it's not related to operations also. And it's not also reducing the fixed asset turnover. Um, I guess that's letter B. So if we are wrong, then we take it. Not quite. The primary objective of working capital management is ensuring operational efficiency to meet short-term obligations and operating expenses. So we're wrong with letter B. It's very clear because we are not minimizing the short-term liquidity. Instead, we are maximizing the liquidity. So the correct answer is operational efficiency. Okay. Okay, so we're wrong. So question number 6. Which of the following ratios is used to assess a company solvency? Solvency, current ratio is not solvency, it's liquidity ratio, quick ratio also. And we have letter C. For me, it's letter C. Now let's go to question number 7. If the company's total liabilities are 500,000 and its total assets is 1 million, what is its debt ratio? Of course, it's 50%. Debt ratio is just debt over the assets. So that's letter B. Next, which of the following would improve the company's liquidity position? Again, the liquidity is the company's ability to satisfy its short-term obligation. Okay? So, if you increase your long-term debt, it doesn't follow that uh, you are improving already your liquidity position, because sometimes, uh, not sometimes, if you analyze the formulas for liquidity, it does not concern any long-term debt. The formula is only focused on the current assets, the quick assets, and the current liabilities, right? So paying off short-term liabilities with long-term funds, maybe, maybe, I guess it will, because the liabilities will become smaller, and of course the current ratio, the quick asset ratio will improve, converting short-term debt into long-term debt. Yeah, it's also viable, and selling inventory for cash. Since inventory is a current asset and cash is a current asset, also it will not affect the current ratio. For example, it might affect the quick ratio. It will improve, but I guess the most probable answer for this one is letter C. So you have to select the best answer. Almost there. Oh no. Converting short-term debt into long-term debt can help, but the more impactful step is selling inventory for cash to improve liquidity. Yeah, yeah, I agree. Of course, liquidity it talks about cash mostly. The cash is the most, you can say that a company is liquid if it has more cash. Okay? So, I agree with that. I agree with that answer with Microsoft Copilot. So, working capital management. A company's cash conversion cycle is the amount of time it takes to convert cash into inventory. It's not. Convert inventory into sales. It's not. Convert sales into cash. Convert resources into cash. Cash conversion cycle. If you can still remember, that is they call this uh, cash payment or payable days. Yeah, that's payable days, I guess. Operating cycle minus payable days, I guess. So operating cycle is converting sales into cash. Yeah, it could pass on that. The operating cycle convert sales into cash. Yeah, but we're talking about cash conversion cycle. So cash into inventory, that's inventory days. Convert inventory into sales. No. Convert resources into cash. It's really challenging. So we have to take note of this. Spot on. Converting sales is the key part of cash conversion cycle because that is operating cycle, and then you have to deduct only the payable days if you can still remember. Which financial statement provides a snapshot of the company's financial position at a specific point in time? So if it is financial position, that's letter B, that's balance sheet. Because the new term for um, balance sheet is statement of financial position. So that's it. Okay, let's continue. Yep. Which ratio would you use to measure a company's efficiency in using assets to generate sales? Oh no. Okay. Which ratio would you use to measure company's efficiency in using its assets to generate sales? So return on assets. So that's net income. Return on assets is actually net income over assets or average assets or average investments. They are interchangeably used with the return on investments. So asset turnover ratio, which is what is that asset turnover ratio? I guess asset turnover ratio is return on sales, and then turn on sales is all about net income over sales. Assets, average assets, that's the turnover, and sales, that's sales over asset turnover ratio is based on my memory. That's sales over assets. Yeah, so maybe it's that because gross profit does not match the efficiency in using assets and sales. There are two elements in the question, assets and the sales, and it's present with letter B. On the gross profit, of course, there is sales, because gross profit is sales minus cost of sales. However, there is the absence of the asset, and debt to equity ratio is not really connected to the question, because debt is liabilities, equity is capital. We're looking at two elements again, assets and sales. So I'll say it's letter B. Yep, correct. The asset turnover ratio measures the company's efficiency in using its assets to generate sales. Okay, so which of the following is considered a liquidity ratio? Return on equity returns are always the profit is considered as profitability ratio. All other types of return on assets, return on investment, return on equity, return on sales, those are profitability ratios. Okay, so letter B is a liquidity ratio, but you have to consider all of the multiple choices before deciding. So quick ratio is the right answer, but we have to look at C and D. Price to earnings ratio is a solvency ratio, and the earnings per share is also related to market ratios. So I'll choose B. Okay, let's sign in. Yep. So what does a negative working capital indicate? The company has more liabilities than current asset. Company has more current liabilities than current asset. Yes, yes, that's it. That's the best. Okay, the company has more current assets than current liabilities. The company is highly liquid. The company is highly profitable. So the best answer is letter A. Right. Now let's go to which of the following measures of a company's ability to generate profit from the shareholders' investments. So net profit margin, the formula for this one is net profit over sales. Because if we say net profit margin, the what's on its name, that's the numerator. So in that case, net profit margin, net profit is the numerator. And if you can see margin, it's always over sales. Okay? So meaning, if someone ask you about the contribution margin, yeah, that is contribution margin, which is just sales minus variable costs, okay, over the sales. It's something like that. Gross profit margin, it's the gross profit over sales. So that's how you determine that's how you remember the formulas efficiently. Okay? So again, generate profit. So that's a return on equity. Yeah. Working capital management. Which strategy might a company use to manage its working capital more effectively? Reducing accounts payable, increasing cash reserves, improving accounts receivable turnover, and expanding inventory levels. So, which strategy might a company use to manage its working capital more effectively? So, working capital. So, reducing accounts payable. I don't think that's really a perfect answer, because we're talking about uh, using the working capital more effectively. Sometimes it's not good to reduce your accounts payable for the company, because it might mean that you have to pay immediately your short-term obligations like this accounts payable. And if you're paying it promptly, sometimes there will be an issue on your cash inflow because your cash inflow depends on your operations. So actually, it's not 100% reducing the accounts payable in order to say that you are managing your working capital effectively. Okay? Because if ever you have a longer cash inflow period, then it means that you have to avail for a debt in order to satisfy your accounts payable immediately. Increasing cash reserves. It doesn't necessarily mean that you are also managing your working capital effectively if you increase cash reserve. You're improving the liquidity, sure. But sometimes, if it is excessive already, then you are already foregoing some opportunities, right? Improving accounts receivable turnover. This is this might be the answer because it's good that you have to improve your accounts receivable turnover. So the better your accounts receivable turnover, the lesser investment in accounts receivable. But then again, um, that might include what do you call this sacrifice on your profitability, because if you improve the accounts receivable turnover, that means you wanted your customers to pay more promptly, right? So if you wanted to pay your customers to pay promptly, you'll have some discounts given to the customers that are paying promptly, or else you have to choose your customers wisely, right? So you will have some uh, sacrifice on the profitability side because not all can avail your accounts receivable already, only those who have a good credit image, right? Or else you have to exert more effort to collect the accounts receivable, and sometimes that entails cost. But since the question is managing working capital more effectively, so this might be it, because we do not care in this question, you do not care the profitability, right? Expanding inventory levels, it does not necessarily mean that you are using your working capital management effectively, right? Does that mean that? It's just expanding inventory levels. So meaning you have to produce a lot of inventories, for example, and there are sacrifices in the working capital side, like you have to sacrifice cash, you have to sacrifice something in order to expand your inventory levels, and you have to assume risk because if your inventories are fungible or it can be spoiled immediately, then expanding inventory levels is very much risky, right? So I'll answer letter C. This is nice. Which ratio indicates how much profit a company earns with respect to its overall revenues? Um, Return on sales. Because um, one, profit, that is highlighted in question 16. Profit, and then revenue is sales. So that's only present in return on sales. Not quite. The net profit margin is the ratio that indicates how much profit a company. Ah, oh no. The net profit margin is net profit over sales, right? Okay, so that's a tricky question because return on sales is also net profit, right? Over sales. Okay, which financial statement reports a company's financial performance over a specific period of time? So that's income statement, performance. What does the term net working capital refer to? Net working capital, total assets minus total, no, it's net assets. Letter A is talking about net assets. Current assets minus current liabilities. It could be, but let's look at C and D. Long-term liabilities minus current assets. No. Total equity minus total no. Letter D is not happening. And total equity minus total liabilities. What's that? So my answer is letter D. So you got it. So which ratio helps investors understand the long-term debt paying ability of the company or solvency? Okay? So solvency ratios, we have interest coverage ratio. Yeah? That's, what do you call that? I forgot. But interest coverage ratio is, I guess, earnings before interest and taxes. So basically, that's net income before deducting any interest expenses and before deducting tax expenses over your interest. So I guess that's the answer. But let's take a look at the others. Current ratio, quick ratio, those are liquidity ratios. And inventory turnover ratio is related also to the, what do you call this, working capital or liquidity ratio. So let's have A. Yeah. So what does the quick ratio measure? Quick ratio measure. The ability to meet long-term obligations. B. The company's ability to meet short-term obligations without relying on inventory. Yeah. Yeah. That might be it. Okay. Because letter A is pertaining to current ratio also. So it's a little bit vague. But letter B is specific. Letter C, company's profitability over the fiscal year. No, that's not the quick ratios. Uh, Profitability is not the concern of quick ratio. The company's efficiency in using its assets to generate revenue. It's not also the purpose of quick ratio. Okay, so letter B. So this is the last question, I guess, for this video. So I would like you to practice more and more in order that you'll be able to enhance your stamina in answering questions, because if you are subjected to a very long test like an exam like 70 items or 100 items, you have to have stamina. Okay, so mostly the questions that were given to me by Copilot is theoretical in nature. So I guess on the next episode, let's have a problem solving, so still using the Copilot. Okay, and then of course, always remember that aside from building stamina, you should also ask yourself about those questions that you got wrong, and you have to explain why you are wrong there. Because if you do not explain why you are wrong there, if it happens to come back, you will still be wrong. Okay? So you have to be 100% sure already that you understood the question that you are wrong with, why you are wrong, and what is the correct answer. Okay, so that's it for this episode. See you on my next one.